The global financial landscape, as of late June 2025, presents a complex tapestry woven with threads of uncertainty and opportunity. Markets are currently navigating a delicate balance, heavily influenced by the shifting policies of major central banks around the world. The era of synchronized monetary tightening appears to be giving way to a more divergent path, creating significant crosscurrents that traders must carefully chart. This divergence is a primary source of the volatility we are witnessing across asset classes, from equities to fixed income and, most notably, in the foreign exchange and commodity markets. Understanding these macroeconomic drivers is the first and most critical step in formulating a sound trading strategy in this environment. A significant theme dominating the current narrative is the palpable weakness in the US dollar. After a prolonged period of strength, the greenback has begun to lose its upward momentum, a development with far-reaching consequences. This shift is not occurring in a vacuum. It is a direct result of market participants recalibrating their expectations for the Federal Reserve's policy trajectory relative to its global counterparts. As speculation grows that the Fed may be nearing the end of its tightening cycle or even contemplating future easing, the dollar's appeal as a high-yielding currency has diminished. This dynamic directly impacts every major currency pair and provides a significant tailwind for dollar-denominated commodities, at least in theory. Compounding this complexity is the pronounced volatility in commodity prices. While a weaker dollar typically provides support for commodities like gold, silver, and oil, other powerful forces are at play. Concerns over the trajectory of global economic growth, particularly in key consumer nations, are acting as a significant headwind, capping potential price rallies. This creates a fascinating push-and-pull scenario where the currency tailwind is met with a fundamental headwind. For traders, this means that traditional intermarket relationships, while still relevant, cannot be taken for granted. One must look deeper into the specific supply and demand fundamentals of each commodity to gain a clearer picture. Therefore, the current market environment demands a multifaceted approach to analysis. It is no longer sufficient to focus on a single driver, such as central bank policy or currency movements alone. Instead, a successful trader must synthesize these elements, understanding how they interact and influence one another. The weakening dollar, divergent central bank paths, and fluctuating commodity prices are not separate stories. They are interconnected chapters of a single, evolving narrative. The sections that follow will delve into specific assets, applying the principles of technical analysis to identify key levels and potential scenarios within this broader, volatile context. Gold, the traditional safe haven asset, is currently facing significant technical pressure despite the backdrop of a weakening US dollar. The yellow metal has struggled to maintain its upward momentum, recently falling below several key short-term moving averages, a sign that the bears are gaining control in the immediate term. The price action suggests a period of consolidation at best and a deeper correction at worst. The primary resistance level to watch is the $2,250 per ounce mark, which represents a recent peak and a psychological barrier. Until gold can decisively reclaim and hold above this level, the outlook remains cautious, with sellers likely to emerge on any attempts to rally. The critical question for traders is where potential support lies. The chart points to a major support zone around the $2,150 per ounce area. This level is significant not only because it represents a prior consolidation zone but also because it aligns with a key long-term trend line that has underpinned the bull market for over a year. A break below this level would be a technically significant event, potentially signaling a more profound shift in market sentiment. Such a move could open the door for a further decline toward the psychological $2,100 level, which would likely trigger a wave of stop-loss orders and accelerate the downward momentum. The pressure on gold can be attributed to several factors that are currently outweighing the benefits of a weaker dollar. While yields on government bonds have eased slightly, they remain at historically elevated levels, increasing the opportunity cost of holding a non-yielding asset like gold. Furthermore, the absence of a significant, immediate geopolitical or financial crisis has somewhat dampened the safe haven demand that often propels the metal higher. Traders are therefore watching the interplay between bond yields and the dollar for clues, as a renewed decline in yields could provide the catalyst gold needs to find a bottom. For those navigating the gold market, the strategy should be one of patience and discipline. Watching the price action around the $2,150 support level is paramount. A strong bounce from this zone, confirmed by bullish candlestick patterns and rising volume, could present a favorable buying opportunity with a clear, risk-defined entry. Conversely, a decisive daily close below this level would be a strong signal to either stand aside or consider short positions. The battle between the bulls and bears is being fought at this critical technical juncture, and its outcome will likely set the tone for the coming weeks. The EUR-USD currency pair, the most heavily traded in the world, has been a primary beneficiary of the broad-based weakness in the US dollar. The pair has staged an impressive rally in recent weeks, breaking through several layers of technical resistance to trade near multi-month highs. The current price action is hovering around the 1.0950 level, a significant psychological and technical area. However, technical indicators such as the Relative Strength Index are beginning to show signs of overbought conditions. This suggests that while the underlying trend remains bullish, the pace of the ascent may be unsustainable, and the pair could be vulnerable to a pullback or a period of consolidation. The primary driver of the euro's strength has been the market's perception of monetary policy divergence between the Federal Reserve and the European Central Bank. While the Fed is seen as potentially pausing its rate hikes, the ECB has maintained a more hawkish rhetoric, signaling that further tightening may be necessary to combat persistent inflation in the Eurozone. This interest rate differential narrative has fueled demand for the euro. However, this narrative is now being tested as speculation begins to mount that the ECB itself may be forced to consider rate cuts sooner than previously anticipated, especially if economic data from the bloc continues to weaken. This evolving outlook on ECB policy is a critical factor for traders to monitor. Any hint from ECB officials that their hawkish stance is softening, or any piece of economic data that points to a sharper than expected economic slowdown, could quickly undermine the euro's recent gains. The 1.0800 level now stands as a key initial support area. This level represents a former resistance zone that should, in theory, now provide a floor for any corrective move. A break below this level would suggest that the recent rally was a false dawn, and could shift the immediate technical outlook back to neutral or even bearish. In the current environment, trading EUR-USD requires a nimble approach. While the path of least resistance appears to be higher, the risk of a sharp reversal is elevated due to the overbought conditions and the shifting central bank narrative. Traders looking to initiate long positions might consider waiting for a pullback toward the 1.0800 support level to find a more favorable entry point. Conversely, the 1.0950 to 1.1000 zone represents a formidable resistance area where profit-taking is likely to increase. Watching for signals of trend exhaustion in this region will be key for managing risk and capitalizing on potential short-term reversals. West Texas. Intermediate crude oil finds itself in a precarious technical position, struggling to overcome persistent downward pressure. The price has been unable to sustain any meaningful rally above the key $75 per barrel level, which has now solidified itself as a formidable line of resistance. This price point is significant as it aligns with the 200-day moving average, a long-term trend indicator widely watched by institutional traders. The repeated failures to breach this ceiling suggest a lack of conviction from the bulls and indicate that sellers are firmly in control whenever the price approaches this zone. This pattern of behavior is a classic sign of weakness in a market. The fundamental picture for oil is equally challenging, providing the backdrop for the bearish technical signals. Persistent concerns about the health of the global economy are weighing heavily on demand forecasts. Slower growth in major economies like China and Europe translates directly into lower expected consumption of petroleum products, creating a supply-demand imbalance that favors lower prices. While geopolitical tensions and production cuts from OPEC+ offer some measure of support, they have so far been insufficient to offset the broader macroeconomic fears that are currently dominating market sentiment and keeping a lid on any potential price advances. A further drop in WTI crude could have significant implications. The next major area of technical support is located around the $68 per barrel mark. A decisive break below this level would represent a significant bearish development, potentially signaling the start of a new leg down. Such a move would not only confirm the strength of the downtrend, but could also trigger a cascade of selling, pushing prices toward the lower end of their multi-year range. For the broader market, a sustained drop in oil prices could be interpreted as a deflationary signal, potentially influencing central bank policy and impacting inflation-sensitive assets. For traders focused on the energy market, the current setup calls for caution. The inability to break above $75 is a clear red flag. Short-term strategies might involve selling into rallies that approach this resistance level, with a tight stop-loss placed just above it. For a more bullish case to develop, oil would need to not only close decisively above $75, but also hold above the 200-day moving average for several consecutive sessions. Until that happens, the prevailing trend remains downward, and the risk is skewed to the downside, with the $68 support level being the next critical battleground to watch. The USD-CAD currency pair is currently emblematic of a market caught between two powerful opposing forces, resulting in a distinct range-bound price action. On one side, the broad-based weakness of the US dollar is exerting downward pressure on the pair. As the US dollar index or DXY trends lower, it naturally makes it more difficult for USD-CAD to sustain any significant upward momentum. This factor alone would typically suggest a clear bearish path for the pair. However, this is only half of the equation, and the other half is providing a crucial counterbalance that is keeping the pair locked in a technical stalemate for now. The primary offsetting force is the concurrent weakness in crude oil prices. Since Canada is a major oil exporter, the value of the Canadian dollar is closely correlated with the price of WTI crude. The ongoing struggles of oil, with its price pinned below key resistance levels, is preventing the Canadian dollar from capitalizing fully on the US dollar's weakness. This dynamic creates a lesser of two evils scenario for the currency pair, where both the numerator, the US dollar, and the denominator, the Canadian dollar, are facing headwinds. The result is a choppy, sideways market that lacks clear directional conviction, which can be, pretty frustrating for trend followers. From a technical perspective, the pair has been oscillating within a relatively well-defined range. The key support level to watch is the 1.3300 area. This zone has been tested on multiple occasions in recent months and has held firm each time, proving its significance as a demand floor. On the upside, resistance is found near the 1.3650 level, which has capped rallies. Trading within this range requires a different strategy than trading a trending market. Traders might look to buy near the support at 1.3300 and sell near the resistance at 1.3650, while always being mindful of the potential for a breakout. A decisive break of this range will likely be triggered by a significant move in either the US dollar or crude oil. A sharp recovery in WTI crude above its $75 resistance, for instance, would likely strengthen the Canadian dollar and could finally push USD-CAD below the critical 1.3300 support. Conversely, a surprising resurgence in US dollar strength or a further collapse in oil prices could provide the fuel for a breakout above the 1.3650 resistance. Until one of these catalysts materializes, traders should respect the boundaries of the range and manage risk accordingly, as whipsaws are, honestly, pretty common in such environments. Silver, often considered gold's more volatile cousin, is currently exhibiting pronounced technical weakness, underperforming its yellow metal counterpart. The price has recently broken below its 50-day moving average, which is a key indicator of medium-term trend and momentum. This break is a significant bearish signal, suggesting that the control has shifted from buyers to sellers. The precious metal is struggling to find a solid footing, and every attempt at a rally has been met with fresh selling pressure, creating a pattern of lower highs and lower lows on the short-term charts. This price action is characteristic of a market in a corrective phase. For silver to regain any semblance of upward momentum, it must first overcome a critical area of resistance. The immediate hurdle is the aforementioned 50-day moving average, which currently sits around the $28 per ounce level. A convincing close above this moving average would be the first step in repairing the technical damage. However, a more significant challenge lies at the $29.50 resistance zone. This level represents a prior support area that has now flipped to become resistance, which is a classic technical principle. A breakout above this level would be needed to signal a true reversal of the current downtrend and potentially attract new buying interest. The weakness in silver can be attributed to its dual nature as both a precious and an industrial metal. While it benefits to some degree from the same monetary factors as gold, such as a weaker dollar, its industrial component makes it highly sensitive to perceptions of global economic health. With growing concerns about a potential slowdown in manufacturing and industrial activity, the demand outlook for silver is definitely clouded. This industrial headwind appears to be overpowering the monetary tailwind at present, leading to its relative underperformance compared to gold and, honestly, keeping the bulls on the defensive. Traders should approach silver with a cautious stance until the technical picture improves. The path of least resistance is currently to the downside. The next major support level to watch is around the $26 per ounce mark, which is a psychological level and a zone of previous consolidation. A break below this support could accelerate the decline. For a bullish case to emerge, traders need to see a decisive reclaim of the $28 level, followed by a sustained push above the more formidable $29.50 resistance. Until then, risk management is key, and chasing rallies in this environment could prove to be a costly mistake. In a market environment characterized by divergent central bank policies and heightened volatility, the principles of sound risk management become not just important, but absolutely essential for survival and success. The rapid shifts in sentiment we're witnessing can lead to sharp, unexpected price swings that can inflict significant damage on an unprepared trading account. It's precisely during these times that a disciplined approach to managing risk separates professional traders from amateurs. The temptation to take on excessive risk in pursuit of quick profits is high, but it's a temptation that must be rigorously resisted in favor of capital preservation. Effective risk management begins before a trade is even placed. It involves determining an appropriate position size relative to one's account equity, ensuring that no single trade can result in a catastrophic loss. A widely accepted rule of thumb is to risk no more than 1 to 2% of your trading capital on any individual trade idea. This practice ensures longevity in the market, allowing a trader to withstand a string of inevitable losses without being forced out of the game. It actually mathematically guarantees that you can be wrong many times in a row and still have the capital to continue trading and wait for your strategy's edge to play out. The stop-loss order is the most critical tool in a trader's risk management arsenal. It's a predetermined price level at which a losing trade is automatically closed, limiting the potential damage. Placing a stop-loss shouldn't be an emotional decision. It should be based on sound technical analysis, set at a logical level that invalidates the original trade thesis. For example, if you're buying at a support level, the stop-loss should be placed just below it. Failing to use a stop-loss is kind of like navigating treacherous waters without a life raft. It's an unnecessary and potentially devastating gamble with your financial well-being. Furthermore, risk management extends beyond single trades to encompass the overall portfolio. This includes being aware of correlations between different assets. For instance, holding long positions in both gold and silver simultaneously in the current environment might seem like diversification. But since both are under pressure, it may simply be doubling down on the same risk factor. A prudent trader will constantly assess their total market exposure, ensuring they're not overly concentrated in one direction or asset class. In these uncertain times, a defensive mindset focused on protecting capital is really the bedrock upon which all profitable trading is built. Now, more than ever, the decisions and communications from the world's major central banks are the primary catalysts driving market volatility. These institutions, including the U.S. Federal Reserve, the European Central Bank, and the Bank of Canada, wield immense power over financial conditions through their control of interest rates and their outlook on the economy. Every scheduled meeting, every set of meeting minutes, and every speech by a central bank governor is scrutinized with extreme intensity by market participants. These events have the power to create, reverse, or accelerate trends across all asset classes in an instant, making them critical focal points for any trader. The market's obsession with central bank policy stems from the direct impact of interest rates on asset valuation. Higher interest rates generally increase the attractiveness of holding cash and fixed income instruments, making riskier assets like equities less appealing. They also directly influence currency exchange rates, as global capital flows toward countries offering higher yields. As we're seeing with the US dollar, even the expectation of a change in policy can be as powerful as the change itself. This is why traders must not only react to decisions but also anticipate them by closely following the economic data that informs these decisions. Key economic data releases therefore serve as the breadcrumbs that lead to future central bank actions. Reports on inflation, like the Consumer Price Index or CPI, employment data, such as the non-farm payrolls report, and economic growth metrics like gross domestic product or GDP are absolutely paramount. A higher than expected inflation reading, for example, might increase the probability of a central bank maintaining a hawkish stance, which could strengthen its currency and put pressure on assets like gold. Conversely, a weak employment report could fuel speculation of future rate cuts, weakening the currency and potentially boosting risk assets. In this data-dependent environment, traders must maintain a detailed economic calendar and be aware of when these high-impact releases are scheduled. Volatility is almost guaranteed around the time of these announcements, and it's often prudent for short-term traders to reduce their exposure or avoid taking new positions immediately before a major release. The subsequent price action and the market's interpretation of the data provide valuable clues about the underlying sentiment. Paying close attention to how the market reacts to news, whether it shrugs off bad news or sells off on good news, can actually be more telling than the data itself. In summary, the global financial markets are at a fascinating and challenging crossroads. The overarching themes are clear. Divergent central bank policies are creating currency volatility. A weakening US dollar is reshaping intermarket relationships, and concerns over global growth are weighing on commodity prices. Navigating this landscape requires a keen focus on key technical levels and a disciplined risk management framework. For gold, the critical battle is being waged at the $2,150 support level. A hold here could signal a bottom, but a break would open the door to a much deeper correction, making this level the primary focus for precious metals traders. For currency traders, the key pairs offer distinct scenarios. The euro-dollar has shown impressive strength but is now facing overbought conditions and resistance near 1.0950, with the evolving ECB policy outlook serving as a potential catalyst for a reversal. Support at 1.0800 is the line in the sand for the current uptrend. Meanwhile, the dollar-loonie remains locked in a stalemate, bounded by support at 1.3300 and resistance at 1.3650. A breakout will likely be dictated by a decisive move in either crude oil or the broader US dollar, making patience a virtue for traders of this pair. In the commodity space, both oil and silver are flashing warning signs. WTI crude oil's inability to overcome the $75 resistance level keeps the bears firmly in control, with a potential test of the $68 support on the horizon. A break above 75 is needed to shift the bearish narrative. Silver's situation is similar, with the metal trading weekly below its 50-day moving average. It must reclaim the $29.50 resistance level to signal a return of bullish momentum, with the $26 level acting as the next major support target for sellers. The ultimate takeaway for any market participant in June 2025 is the paramount importance of discipline. The current environment is not one for reckless speculation. Actionable guidance must be rooted in defense. Always use stop losses, keep position sizes reasonable, and be acutely aware of the event risks surrounding central bank announcements and major economic data releases. Watch the key levels outlined in this analysis closely, as the market's reaction at these junctures will provide the most reliable clues for future price direction. By combining sound technical analysis with a steadfast commitment to risk management, traders can successfully navigate the volatility and capitalize on the opportunities that arise. If you enjoyed this analysis, please like and subscribe to our channel for more updates.